Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Wednesday, July 15th, 2026. We're Elena and Marcus.
Well, it's quite a complex day in the markets today. We're looking at some really unusual cross currents.
We really are. Imagine a scenario where a massive missile strike and a naval blockade in the Middle East barely move the price of oil.
Right.
But then a single European tech company mentions the word capacity, and, well, billions of dollars just vanish from global equities.
It's a completely upside-down environment for investors to navigate. So looking at today's data deck, we're tracking three major themes for you. First up is the macro pivot.
Right. The bond market is having a very aggressive reaction to some back-to-back cooler inflation data.
Yeah, and it's forcefully driving yields down across the entire curve. The second theme is what we're calling the great equity rotation.
Because our daily desk data shows this massive historical shift in institutional flows, capital is just draining out of those crowded semiconductor trades and pouring straight into large cap financials and hyperscalers.
Yeah, those massive cloud providers, like Amazon AWS and Microsoft Azure. And their third theme is the commodity disconnect. There's this glaring paradox in the energy markets right now.
Crude oil remains oddly subdued despite a severe geopolitical supply shock. We are talking a hit of millions of barrels per day.
Correct. So we're going to unpack exactly how these mechanisms are working and what these themes mean for your portfolio, starting with that broader macroeconomic picture.
Moving to today's data, let's look at the mechanics of the bond market. We had softer than expected June Producer Price Index, or PPI, data cross the wires this morning.
Right. And PPI basically measures wholesale costs. So if producers are paying less for materials, they eventually pass those savings on to consumers.
Exactly. So this soft PPI data is acting as a powerful multiplier to yesterday's downside surprise in the Consumer Price Index print. The reaction in treasuries was just immediate.
It really was. The two-year Treasury yield dropped roughly 4 basis points to 4.147%.
And the 10-year yield eased 4 basis points to 4.549%.
But the real drama, the most aggressive movement, was at the very front of the yield curve. The one-year yield saw the biggest drop of the entire session.
Down 6.1 basis points, right?
Right, falling to 3.965%. So it officially slipped under that 4% mark.
Which tells a very specific story about monetary policy expectations. The market is now officially pricing out a July Federal Reserve rate hike.
Yeah, the probability on that is now well under 17%.
And institutional consensus is pushing expectations for the very first actual rate cut all the way out to December 2026.
Though it's vital to note that Fed officials are kind of mixed on this timeline. On one hand, some are saying rates are well positioned, they're comfortable pausing.
But then others are explicitly warning they are prepared to act if this disinflationary trend stalls out.
Correct.
Well, we are seeing the yield curve steepen, with the front end dropping much faster than the long end. For the everyday investor looking at their portfolio, what does this specific dynamic, cheaper short-term borrowing costs, actually signal about the broader economic regime?
That is the essential question to ask when looking at our proprietary updates. When the front end drops aggressively, like we saw today, it acts as a pressure release valve for rate-sensitive assets.
Like housing and commercial real estate.
Right, and small-cap companies too, like those in the Russell 2000. A lot of those firms rely heavily on short-term floating-rate debt to fund their daily payroll and operations.
So it essentially gives the broader economy room to breathe without completely taking the foot off the brake.
Indeed. It signals we are moving toward a sort of Goldilocks scenario. The economy isn't running so hot that inflation spirals, which would force punishing rate hikes.
But the data also shows we aren't facing an immediate recessionary panic either.
Exactly. It's a manageable deceleration. We're seeing a cooling effect on inflation, which allows the Fed to step back, but the underlying economic engine isn't stalling out completely.
Understood. Moving to today's data on the equity side, that macroeconomic relief did not lift all boats. Quite the opposite, really. Our latest run shows a deeply bifurcated equity tape.
Yeah, on the surface, the cap-weighted S&P 500 closed up about 38 basis points.
But that was driven heavily by a massive $4.9 billion mark on close buy order.
Right, which signifies very aggressive, highly concentrated institutional buying right at the closing bell. It's not retail money.
But looking under the hood of our daily desk data, the equal weight S&P 500 was actually down 20 basis points today.
Which reveals extremely narrow market leadership. We are seeing a historic rotation playing out in real time.
Let's talk about the pain in semis. AMD fell 3.5% and ASML dropped 0.4%.
Even though ASML actually beat their forward guidance by over 10%, dealer desks are calling this a momentum wobble.
Because the market is hyper-focused on capacity expansion concerns, right? The capital expenditures for all this artificial intelligence infrastructure are just massive.
Correct. The earnings bar in the semiconductor space is so elevated now that even a 10% beat gets met with selling pressure. Investors are starting to question the timeline for the return on investment for all these expensive chips.
Meanwhile, financials are hitting all-time highs today. Morgan Stanley rose 0.4% on absolute record equities trading revenue.
And BlackRock is another prime example. The stock surged 6.6% today, after hitting a record $15.34 trillion in assets under management.
When the largest asset manager in the world pulls in that kind of capital, it's a massive structural tailwind for the whole sector. We also have to call out PayPal, jumping 17.2% on a massive $60.50 per share buyout offer from Stripe and Advent.
And looking globally, this tech rotation has varied effects depending on the region. In Asia, the KOSPI surged 6.24% today on tech supply chain optimism,
which diverges from the specific weakness we saw in U.S. semiconductor equipment makers. But looking at our daily desk data, this doesn't look like routine profit-taking.
No, it doesn't.
It looks like a coordinated evacuation. Our daily desk data shows hedge funds have slashed their AI holdings by 60 to 70% over just the last 5 weeks. Are we witnessing retail exhaustion here, or is this fundamental institutional deleveraging?
It is definitively an institutional deleveraging phase. If you look at the retail side, call option buying has retreated significantly from its June peak of nearly 14 million contracts.
So the speculative retail froth has essentially been blown off the top of the market.
Correct. But the heavier anchor is institutional behavior. Our proprietary updates show mutual funds have sold off roughly $210 billion in equity beta year to date.
Meaning they are just dumping broad market exposure.
Right. This is structural de-risking. Investors are fleeing high-valuation micro-volatility for the safety of mega-cap financials and hyperscalers.
On that point, moving to today's data in the commodity sector, we are seeing pricing action that just defies fundamental logic. WTI crude rose a mere 0.51% to roughly $80.24 per barrel.
While in the metals complex, silver plunged 3.25% to $56.90 an ounce.
And gold ticked up 0.21% to roughly $4,066. But let's focus on crude oil, because there is a massive geopolitical paradox at play here.
There really is.
The supply shock happening right now is severe. We're looking at the closure of the Strait of Hormuz, fresh U.S. airstrikes on Iranian targets, and a reimposed naval blockade.
And to put hard numbers to that, our internal data models estimate a 13.4 million barrel per day hit to global oil flows from all of this.
Normally, a 13 million barrel supply shock in the Persian Gulf would send crude into the stratosphere. Why is WTI barely holding a 50 basis point gain?
Well, the market is actively weighing two massive counterforces. First is geopolitical trust. The market is assuming that U.S. military escorts will successfully secure commercial transit through the strait.
So they believe the blockade won't stop the crude from flowing.
Exactly. And the second counterforce is severe demand destruction fears, which is why we need to look at silver.
Because silver isn't just a precious metal, it's a key industrial component. So a steep 3.25% drop acts as a proxy for the global industrial machine.
Indeed. That drop proves the market is deeply concerned about slowing global economic growth. They're calculating that even if 13.4 million barrels per day are removed from the supply side, a looming industrial slowdown could destroy an equivalent amount of energy demand.
So that profound fear of global economic deceleration is acting as a heavy lid, capping energy prices despite the absolute chaos on the supply side.
Correct.
Understood. So when we synthesize our daily desk data across these three distinct blocks, we see a highly fractured environment. We have a bond market celebrating disinflation.
We have an equity market rotating aggressively into financials while punishing crowded technology trades.
And a commodity market flashing bright warning signs about global industrial demand. What do all these simultaneous moves suggest about the broader economic regime?
What this synthesis suggests is a fundamental change. We have officially shifted from macro-driven volatility to idiosyncratic, micro volatility.
Meaning the days of broad macro correlations dictating the tape are over. For the past 2 years, everything moved together. If inflation was up, everything sold off. Today, those correlations have completely collapsed.
Right, which brings us to a stunning metric from today's proprietary updates. Single stock implied volatility is currently sitting at the 99th percentile.
That is the mathematical definition of microvolatility. The risk is intensely focused on what a specific company is doing rather than the broader index.
Indeed. And it leaves us with a forward-looking puzzle. The entire soft landing narrative that's currently propping up bonds and large-cap financials relies entirely on energy prices staying contained.
Right.
But with 18% of new investment-grade credit issuance now tied directly to funding AI infrastructure, you have to ask yourself a very difficult question.
What happens if it breaks?
Exactly. If the geopolitical situation in Hormuz escalates and those military escorts fail, causing oil to suddenly reprice $15 higher, does that instantly shatter the benign inflation data we celebrated today and pull the rug out from under both the bond and equity markets?
That is the crucial risk to monitor. To quickly recap today's briefing, Treasury yields dropped significantly as softer PPI data reinforced the disinflation narrative. In equities, institutions are executing a massive rotation out of semiconductor names and into mega-cap financials amid a broader AI deleveraging phase. Finally, in commodities, crude oil's strangely muted response to a severe geopolitical supply shock highlights a growing tension between physical supply disruptions and deep underlying fears over global industrial demand destruction. Thank you for listening to Market Pulse by Orestes Capital. We're Elena and Marcus. We'll be back tomorrow with the latest market color.